What a year for stock prices it's been. Green screens almost every time you look up, record openings, intraday highs, record closings, a party on Wall Street. The Dow Jones Industrial Average closed in record territory some 70 times in 2017. Gains of 25%, not seen for years. The popular consensus? There are 4 key reasons. Early in the year, it was the so-called Trump effect. The inauguration of a businessman in the White House boosted investor confidence, someone who might bring business-friendly policies to bear. By the summer, corporate earnings were spurring optimism. One U.S. corporation after another turned in quarterly earnings that beat the street. Wall Street lapped it up. In the autumn, the prospect of tax reform loomed large, the first new tax code in 30 years, and crucially for Wall Street, a big cut in corporate taxes. Slashed from 35% to 21%, Wall Street smelled more economic growth. And there was one more good reason to buy. The global economy was doing better too, marking some of the best gains since the 2008 global crash.
Europe is turning, China's turned at a very strong first quarter, first half. The emerging markets are turning. And a larger percentage of S&P 500 revenue comes from global sources as opposed to, say, 10, 15, certainly 20, 25 years ago.
2017 was also a year for IPOs, initial public offerings, where companies come to market for the first time. There was much hype surrounding the technology and social media company Snap Inc., which debuted in March for investors who could see beyond Snap's comedy filters, which make us all laugh.
It can have e-commerce in there. It can have payments in there. Down the road, maybe you can get some gaming in there. So I think you have 2 or 3 levers that they can pull to keep the user base engaged and monetize them.
But Snap Inc. stock has struggled since its IPO, and investors are hoping a recent investment from Chinese firm Tencent, which bought a 12% stake, may help stabilize things. In fact, Chinese companies are choosing to trade in the US more and more. By the end of 2017, there were more than 160 of them, including Lechin Fintech, which began trading at the Nasdaq in late December. A microloan tech firm, it aims to use technology to bring Chinese people better, more efficient borrowing.
The product itself is not that unique, but the technology behind the product, that's where the unique thing comes from. And that will make us different than others.
And staying at the Nasdaq, it was the so-called FANG stocks, many traded there, that were the big stars of 2017, driving market growth for most of the year. Facebook, Amazon, Netflix, Google, and not forgetting Apple and Microsoft, a basket of some of the most exciting companies in the world today. Investors wanted in on their futures. At year's end, everyone's hoping the party will continue into 2018. Why wouldn't they?
There really is no way to know for sure. Some say the corporate tax cuts will keep the party going. Others warn economic headwinds are just around the corner. They worry that the stock market run-up is a bubble that's about to burst.
Met with more than 100.
But the era of Trump has ushered in uncharted territory. All the old norms seem not to be true anymore. So when it comes to stock buying, the old trader adage remains as true today as ever. Buy cheap, sell high. John Terrett, CGTN, New York.